for tuning in to today's podcast on the insane fraud of Crazy Eddie. I'm Landon Mold.
I'm Emily Dondlinger.
And I'm Leah Parker.
Today we have the opportunity to dive deep into a story that is honestly stranger than fiction. We're talking about the Crazy Eddie fraud case, a massive scheme that ran for years and fooled some of the smartest people in finance.
For those of you who might be too young to remember, Crazy Eddie, founded by a man named Eddie Antar, was the electronics retail giant of the 1970s and 80s.
If you lived in the New York or New Jersey area, you couldn't turn on the TV without seeing their ads. But as we're going to discuss today, the insanity wasn't just a marketing gimmick, it was a business model based in deception.
So where did this all start? It began as a small retail chain in Brooklyn, New York. Eventually, it expanded across the entire tri-state area. But the founder, Eddie Antar, he was a character.
Character is putting it lightly. Eddie was an incredibly intense salesman. There are stories that if a customer tried to leave the store without buying something, he would just keep cutting the prices until they caved.
He'd even lock the front door. Imagine being a customer just wanting to browse and suddenly you're trapped. There's even a famous story about him persuading a customer to take their shoes off. I don't even know how he managed that, and then he'd taunt them.
Right? He'd say, "You want your shoes back? We're going to make a deal." That's the kind of high-pressure environment we're talking about.
And it worked because of the branding. He had that iconic ad campaign, Crazy Eddie. His prices are insane. It was someone screaming that line in dozens of radio and TV ads. It became a huge part of pop culture.
But behind the screaming and the cheap VCRs, there was a dark side. This wasn't just Eddie, it was the whole Antar family.
That's the craziest part. The family was in it from day one. Many family members later admitted that the scheming started the moment the first store opened.
One of the main things they did was just classic tax evasion. They wouldn't report sales, so they wouldn't have to pay taxes on them. Managers would get these small salaries on paper, but then they'd get under-the-table cash payments.
It was a win-win for them. The business reduced its costs, and the employees didn't pay income tax. But then things got sophisticated when Eddie's cousin, Sammy, entered the picture.
Sammy is a fascinating character. He went to college for accounting and finished at the top of his class.
Think about that. He studied accounting specifically to see how auditors catch fraud. He learned the enemy's playbook. Once he graduated, he became the chief financial officer.
Having a certified expert in the family gave them a massive advantage. He knew exactly how to keep the fraud undetected.
And in the 1980s, they decided to take the company to make even more money. They used a scheme called the pump and dump.
For our listeners, that's when you spread false info to create a buying frenzy, to pump the stock price up, and then the insiders dump their shares at that inflated price to make a quick profit.
Let's look at how they actually moved the money. Every night, store managers would drop off the day's receipts at Eddie's house. This included checks, credit card slips, and usually $2,000 to $3,000 in cash.
They'd deposit the checks and cards, but they'd keep a huge chunk of that cash. It was never reported.
They used that cash to pay employees off the books. Eddie's brother, Alan, is a perfect example. He claimed he only made $300 a week, yet he lived in a mansion and sent his kids to expensive private schools. The math just didn't add up.
They also used the cash to buy inventory off the books. Since they were underreporting sales, they had to hide the purchases too, just to keep the balance sheet looking normal.
And where did the rest of the cash go? Under floorboards, in file cabinets, under beds. But eventually, they ran out of room. That's when Sammy and Eddie came up with the Panama pump.
This sounds like a movie. Family members would literally tape cash to their bodies, fly to Israel, and deposit it in a family account. Then wire it to Panama and finally back to the United States.
When Eddie decided to take the company public, the goal changed. He needed to report profits to attract investors, so they actually reduced their skimming from 300 million down to 750,000, just so the reported net income would look like it was growing massively.
They even counted the laundering Panama money as sales revenue. And when auditors came to check the warehouses, they'd stack boxes in hollow rectangles to make it look like they had even more inventory than they actually did.
Speaking of auditors, they were originally using a small firm called Penn and Harwood. But to look prestigious for investors, they brought in the big guns, Maine Herdman and eventually KPMG.
But Sammy knew how to fool them. He'd find out which stores the auditors were visiting in advance, and he'd move inventory from store to store to cover shortages. In the stores they didn't visit, he'd inflate the inventory by as much as 300%.
He even found where the auditors kept the key to their work papers. He'd spend his night reading their notes so he could prepare explanations for any suspicious activity they found.
But eventually, the numbers stopped making sense. Before the expansion, sales growth was 20%. Suddenly, it spiked to 45%. That was the smoking gun.
Investigators started looking at everything: accounts receivable, inventory, cost of goods sold. The spikes were just too unusual for that time period.
One thing we hadn't talked about yet is the damage this fraud caused to everyday investors.
That's right. When Crazy Eddie went public, thousands of people bought shares believing they were investing in a rapidly growing electronics retailer. The company's financial statements made it look incredibly profitable.
But once the fraud started to unravel, the stock price completely collapsed. Investors lost hundreds of millions of dollars almost overnight.
And it wasn't just investors, employees were affected too. When the company filed for bankruptcy in 1989, thousands of workers lost their jobs as stores were closed and liquidated.
The scandal also shook confidence in the retail industry and in financial reporting more broadly. If a company could manipulate its numbers for so many years without being caught, it made people wonder how many other companies might be doing the same thing.
It also pushed regulators, auditors, and investors to start paying closer attention to warning signs like unrealistic sales growth, unusual inventory levels, and overly aggressive management behavior.
In a strange way, cases like Crazy Eddie helped shape modern forensic accounting and fraud detection techniques.
Exactly. Today, fraud examiners and auditors actually study cases like this in accounting and business classes as examples of how complex financial fraud can be carried out and eventually uncovered.
So while Crazy Eddie disappeared, the lessons from the case are still very much alive in the world of business and accounting.
Let's talk about some of the major warning signs, also known as red flags, that auditors and investors eventually notice in the Crazy Eddie case.
One of the biggest red flags was the company's extremely rapid growth in reported sales. As we mentioned earlier, the company's sales growth suddenly jumped from about 20% to nearly 45%. That kind of increase is unusual for a retail business and should have triggered deeper investigation.
Another red flag was inventory inconsistencies. Crazy Eddie often reported very high inventory levels compared to similar electronic retailers. Inventory is a common area where companies manipulate numbers because it directly affects profit through cost of goods sold.
There were also issues with accounts receivable. Retail stores usually collect payments quickly through cash, credit cards, or checks, but Crazy Eddie's financial statements began showing unusual high receivables, which didn't make sense for that type of business.
A fourth red flag was family control of key positions. Many members of the Antar family worked in management roles. When too many people in a company's leadership are closely related, it increases the risk of collusion and weakens internal controls.
And finally, there was the aggressive and secretive management style. Eddie Antar was known for being extremely controlling and often pressured employees to follow instructions without asking.
When you combine all of these warning signs, unusual growth, inventory manipulation, family control, and aggressive leadership, you start to see a pattern that should raise concern for auditors and regulators.
Today, cases like this are often used in accounting classes to teach future auditors how to recognize fraud risks early.
Because if something looks too good to be true in the financial statements, it probably deserves a closer look.
The fallout was massive. Eddie Antar fled to Israel in 1991. He was a fugitive for 2 years before being caught in 1993.
He ended up serving 6 years in federal prison and was ordered to pay over 121 million in restitution.
Sammy pleaded guilty too, but he only got 6 months. He turned whistleblower and helped the prosecutors. Today, he's actually a forensic accounting expert.
The company itself, it collapsed. The stock price tanked, investors lost hundreds of millions, and Crazy Eddie filed for bankruptcy in 1989. The stores were liquidated and they just vanished.
It's a huge lesson in why internal controls and professional skepticism matter. You can't let family collusion go unchecked.
Exactly. They exploited the predictability of audits. If there's one takeaway, it's that insane brands can sometimes be a distraction from what's actually happening on the balance sheet.
In the end, greed overrode integrity. What started as a Brooklyn shop built by Eddie ended as a cautionary tale for the ages. Before we wrap up, we asked our friends to send in a few questions about the Crazy Eddie fraud case, and we picked a couple to answer.
Our first question was, How did auditors not catch the fraud earlier if it was going on for so long?
That's a great question. One of the biggest reasons is that the fraud was extremely coordinated. Sammy Antar understood accounting and auditing procedures, so he knew how auditors tested inventory and financial records. Because the fraud involved multiple family members and employees, they were able to manipulate documents, move inventory between stores, and prepare explanations ahead of audits.
Another factor was trust. Auditors rely heavily on the information provided by company management. If management is intentionally deceiving them and covering their tracks well, it can take years before inconsistency become obvious.
Our next question is, what were the biggest red flags that eventually exposed the fraud?
The biggest one was the sudden spike in sales growth. Crazy Eddie had been growing at about 20% annually, which was already strong. But then it jumped to around 45%. That kind of dramatic change raised suspicion among analysts and investigators.
There were also inconsistencies in inventory and financial records. Once investigators started digging deeper into accounts receivable, inventory counts, and cost of goods sold, the numbers didn't line up.
Our final question is, what lessons did the accounting world learn from this case?
One major lesson was the importance of professional skepticism. Auditors need to question unusual trends and verify information carefully rather than assuming management is always telling the truth.
It has also highlighted the need for strong internal controls and segregation of duties. When too many key roles are controlled by family members or close insiders, it becomes much easier to hide fraud.
And of course, it reminds investors and regulators to pay attention to warning signs, especially when financial performance seems almost too good to be true.
Those were some great questions. Thanks to everyone who sent them in.
And thanks again for listening to our podcast on the insane fraud of Crazy Eddie.
Until next time, stay curious and stay skeptical.